Guys, the market is extending its winning streak today after yesterday. On this channel, we have a solid lineup. PayPal making a huge move today, and we're going to check in on it. And I'm going to give you a little teaser because tomorrow we are dropping a full PayPal video on the main channel, so you're not going to want to miss that. We're also checking in on Dell and Micron, looking at earnings from Johnson & Johnson, ASML, and Cintas, and then a full stock analysis on Cintas live right here. And the reason we're doing that, it is one of my companies that I would like to own forever. So let's start with what's happening in the market as we speak. NASDAQ up 0.5%. S&P is up 0.35. Dow is up 0.23. And my favorite asset in the world, Bitcoin is up 4% today. Bitcoin is back, baby. This is the FinViz heat map.
Sarcasm, by the way, on the Bitcoin.
Sarcasm on that one. Amazon's up big, Google's up big, Broadcom's up big. A lot of other stuff, Microsoft up big, Apple's up big. So the big names are driving that market. A lot more red, as you can see up in this area. But, you know, we've talked about this in every single channel and every single video that the big names right now are going to drive it. They make up a very large portion of the entire S&P. So you've got to remember that going forward, that these are the ones that are going to drive the price. Okay. Let's go to our biggest winners and losers. Top gainers, PayPal, 17%, $55 per share. A bid from Stripe and a private equity group to buy PayPal at $60.50 per share. Now, I'm a PayPal shareholder. Do not buy it just because I have it. We're here to teach a process. We are never here to give stock tips. You need to watch tomorrow's video on that. A few other companies, CBRE, the real estate business, up 6.5%. Alibaba, another company I own, up $5.50, 4.75% today. Biggest losers, Cleveland's Finest, Progressive Insurance Corporation, down 9.7% today. Don't know why. Dell, down 9.5% today. SanDisk and Micron, two big companies that have ridden this AI hardware boom in the last year, down big. SanDisk, what was SanDisk's all-time high? 2,400 or 2,300 or something like that? Let's see. 2,350. Less than a month ago. It's already down to 1,600, but it's oscillating like crazy. In the last week, it's even. And look at this. Look at this. Oh, wow. A low of 1,478, a high of 1,950. All in the last week. All in the last week. The last month. That 1478, 2354. Last 3 months, 873 to 2354. Guys, I don't believe that's the sign of a healthy market, but again, we're concentrating a lot of money is flowing into a few winners based on momentum. Yes, the story is exciting. AI is exciting. We will never deny that. I use AI every single day in almost everything I do. Is that a fact? I use it a lot. I have a Claude membership. My wife likes ChatGPT. I use Claude for a lot of things. She uses ChatGPT. She calls ChatGPT Chatty Catty. And I think it's funny. And so she talks about it. I'll tell her, please stop asking ChatGPT for medical advice, Lisa. Go see a doctor. All right, let's go check out PayPal because that is the biggest one. I just want to talk, it was as low as $38 a share. Michael Burry came out. Guys, it's really important that you watch tomorrow's video. It's on our main channel. This is Everything Money Plus. The other one is Everything Money, the normal one. You've got to watch it because we do bull cases, bear cases, a full stock analysis. I tell you what I think it's worth. I've owned this. I've been buying it since $80 a share all the way to $40. I don't know what my basis is. It's somewhere in the 50s. So the profit's not going to be big for me because I think the stock is worth more than 60. How much more? That is the question. All right. Let's look up Dell here because Dell is down big today. And Dell's another high flyer. Oh, wow. Yeah, 9.5%. Michael Dell, I think, is worth like $200-some billion. June 1st, it was a $470 a share. Now it's $413. Pays a dividend, $1.46 billion. Our users have it as a buy rating right now. The profit margin's interesting. Look at this. 2.87% profit margin over the last 10 years, 4.69 over the last 5, 6.3 overall. Is this a trend in the business that's continuing on? Is it going to keep going up? Well, here's the problem. Their gross margin is only 19%. That's not a lot. That's like car manufacturer gross margins. So the idea of them getting to 10, 15%, unless they really increase their gross margin, is going to be difficult. So I look at this company, I think high returns on capital, by the way, which we want to see for a company that you can own for a long time. They get high returns on the money that's invested in the business. But it's selling for 31 times free cash flow, 32 times earnings. That's expensive, unless they can really grow their profit a lot. That's the question. And analysts think they can double their profit over the next 5 years. That's a lot of growth, 15% a year. All right, let's check out some Micron action. Because Micron, woo-wee. We made a big video on Micron a couple weeks ago.
That's like 900.
What was that?
Do you see that price?
Yeah, 900. Yeah, it was as, so let's look in the last 3 months. The low of 425, a high of 1255. That's what I love about our software. It just gives you that information, right? You don't have to sit there and go like, oh, where is it? Kind of thing. Man, that's incredible. Year to date. Wow. 284 to 1255. I think the low price was actually like literally that. Yeah, December 31st. Wow. Yeah, but look at this. They're reporting net income of $50 billion, Tim, and $1.67 billion in free cash flow. That's absurd. How is that even possible? That's Enron type numbers right there. I'm not saying it's a scam. Do not listen about that one. I'm not saying it's a fraud. I'm just being funny. But at the end of the day, like if they're spending a lot of money on capital expenditures, it's got to pay off at some point. And if it doesn't, that's a lot of money wasted. A lot of money wasted. All right, let's check out our earnings results today. First company, even though it's not listed here, ASML. Double beat. Revenue beat by 5.5%. Profit beat by 10.5%. Johnson & Johnson, double beat. 1% and 1.75 on revenue and earnings. Cintas, double beat. 1% and 2.5% on earnings per share. Double beats all around. Let's see how the stocks are doing. Stocks. ASML, let's see how that's doing today. Up 2.5%. Okay, J&J. Down 2.7%. That's interesting. And then Cintas, my homeboys, up 4% today. Up 4%. Not close to their all-time high. Still about 15% off their all-time high. So guys, we talk about, Cintas is a boring company. I'm sure a lot of you are like, who the hell is Cintas? What are they doing? Well, Cintas, they're known as the uniform people. They do uniforms. They wash them for, you go to a factory, you get a uniform. They come in, they clean them, they do all that stuff. We used to have, when I had some apartment buildings in Shaker Heights, they would do our runners in the hallways. So they would come, pick them up, clean them, drop off new ones, put logos on them. We love that. It's a boring business, but boring businesses make a lot of money. But again, price to free cash flow of 44. PE of 40. That's a lot for a boring business that's not growing a lot. Now, I will say their profit margin's increasing. Look at that. 14.8, 16.5, 17.5. That's their 10, 5, and 1 year profit margin. And with this gross profit of 50%, they can keep increasing that profit margin. That's great. Good returns on capital. So they're getting good returns on the money that's invested in the business. If you can pay a reasonable price for a company that has good returns on capital, you're probably going to do pretty well. That's the key there. Now, what's the reasonable price? Well, that's what we have to figure out here. That's what we use our stock analyzer tool for. I mean, I'm actually surprised by those revenue growth rates. 8.6% a year for the last 3, 9.8 for the last 5, 9% for the last 10, without doing a lot of acquisitions, very little acquisitions. And this is a $77.8 billion market cap with $83 billion enterprise value. So let's call it $5 billion essentially in debt that generated $1.76 billion in free cash flow. So their debt levels seem pretty reasonable, less than 3 times last year's free cash flow. So let's check out their 8 pillars. 6 checks, 2 X's. Those 2 X's are valuation metrics. They've bought back a few shares, which I'm glad it's not too many because 44 times free cash flow and 40 times earnings for a company that isn't growing a ton. Like it's not like it's growing 20, 30, 40% a year. And we have the price to earnings growth ratio that was requested by our users. The last 5 years is 2.5. The next 3 is looking at 3.5. You want it to be close to 1. That's pretty far away. That means that you're paying a lot of money for very little growth. You're paying more money than you should for that growth. The higher the growth rate, the more you should pay for the company. Of course, like if you have 2 companies, they're exactly the same. They both generate $1 billion in profit, but one can grow their profit 20% a year, the other one 5%. Which one is worth more money? The one that's going to grow 20% a year, of course. But if you pay too much for the 5% one, saying, well, they both make $1 billion. Well, yeah. I used to think the same way years ago. Like, oh, they both make $1 billion. No, you have to pay more for a better prospect. Look at it this way. We just had the Major League Baseball draft. Major League Baseball draft. There's a reason they pay the first guy $10 million and the last guy nothing, basically. Why? Because the first guy has a lot more potential to get to the league faster. Give him more money. He's going to pay you off a lot more. So let's check out what analyst estimates are for Cintas. Doubling their profit from 5 to 1053 over the next 7 years. That's 10% growth a year. All right, not bad. Not bad at all. And look at that revenue growth. Look at this little cute little line just going up almost at a 45-degree angle. $11.5 billion to almost $20 billion over the next 7 years. So not quite 7%, not quite 10% a year. So we have a story. We have some numbers. And the first thing I tell people to do is run it through Stock Analyzer tool before you spend any time researching. And the reason being is I don't want you falling in love with the story. Do some numbers. Have the story affect your assumptions for the future. But if your stock is too far away from the current price, if your price is too far away, then don't waste your any more time. Add it to your watch list, move on. So here's what I did. I did a 10-year analysis. I did 5, 7, and 9% revenue growth. I did profit margin of 16.5, 17.5, and 19.5. It keeps growing, so I'm going to give it a little bit of potential there. Next, what PE would I assign to this business 10 years from now? Well, it's not a big grower, but it's got good and increasing returns on capital. It's a steady business. It's not a lot of hype. I look at that saying, let me do 17, 20, and 23 because the market average is 15 to 16, but this is a better quality business, so I have to give it a premium. Yes, it doesn't have the growth, but it has the quality to it. And when was the last time you heard somebody saying, we're going to go disrupt Cintas? We're going to go take away their business. They're the uniform people. That's it. They're the uniform people. So finally,
by the way, would you say that's a business that like new competitors aren't trying to get into?
Correct. That's what I mean. Nobody's sitting there going like, let me go do this.
People are trying to make new chips all the time.
Software,
new AI
chips,
stuff.
everything.
Yeah.
It's the sexy stuff.
Yeah.
Imagine being a startup founder and you're like, what are you going to do? Well, we're going to clean uniforms.
Yeah, they're going to dominate that business for the next 200 years.
I would be shocked if Cintas was not around in 20 years.
Yeah.
I'd be like, what happened? And that's one of my characteristics for a stock that I want to own forever. And Cintas is one of them. Now, finally, guys, what is my desired return? Now, guys, everyone's desired return is different. Mine's going to be different than yours because of our situations. I've got real estate. I've got businesses. I don't need to make huge returns, but I don't want to, because of that, I buy low cost ETFs and I buy stocks, but the stocks I buy are only based on a high return. I don't want to deal with the hassle unless there's a lot of juice for the squeeze, but yours might be different. So for here, I just put 9% in here just to get the intrinsic value. What's the company worth? Now, you know what else is interesting about Cintas? Nobody is posting about it on social media. There's no hype. There's no viral moment. There's no analyst on TV pounding the table saying you've got to own Cintas if you don't want to be left behind. And that's exactly why it's worth paying attention to. Because here's the truth. The stocks that make people rich over the long run are rarely the ones that everybody's talking about. Look at Warren Buffett. When was the last time you bought a sexy stock? The ones that you make money are the ones that you find that when you have the right process, when you know how to look at a business, understand what it's worth, and identify the price where you actually get the return you're looking for, like I said over there. That's what you're going to watch me do with Cintas over the last few minutes and here coming up. There's no finance degree needed. I don't have a finance degree. There's no complicated math. Guys, this is done behind the scenes in a very, not simple. The hard part here is the data feed. All it is smart assumptions about the future and the right tools. And that's what the Stock Analyzer gives you. That's why this is the number one tool in our software. And when you combine it with all the community of investors that we have who think in a similar way, people who are sharing research, pressure testing ideas, staying disciplined when everyone else is chasing the hot stock of the week, that's when everything changes. So my question, everybody, whenever I do this is, guys, what's that worth to you? If I asked you today, what would be worth for you to have the peace of mind for the rest, but you have to pay it every single day, the peace of mind to be able to know what your stock is worth based on your own assumptions, have people around you who think like you do, not agree with you, but think like you do? Is that worth $1 a day? Of course it is. If it's not, what are you doing? If you're not willing to invest $1 a day into yourself, guys, it's $7 for 7 days for full access for our trial. Click the link below, run whatever stock you've been thinking about buying, see what it's worth before you spend a single dollar or a single minute on it. So we have our numbers here. I hit the analyze button. The stock is currently sitting at $192, and this is why I am cautious. I have a low price of 86, a high price of 170, middle price of 120, and that's where I have it as my watch list. But remember, guys, I have in my watch list to do another step of analysis. It's at 9% to be worth 120 here. So it's probably worth a lot lower to me, and probably to you, because I don't think anybody should buy a stock based on 9%. So guys, if you made it this far in the video, you probably want to learn a process. You probably want to have this deeper understanding of why stocks work in the long run. I have a great video for you to watch next. It's our full course. It'll walk through step by step on how I pick my stocks, how I look at stocks. It is such a good way, and it's one of our most popular videos because people love learning a process, and the people who love learning a process do the best in the long run. So click the link below, watch that video. Thank you for your time.